silver to $3,947 an ounce. That's not my number. That's the number that went viral this week when Tavi Costa from Missouri Capital shared a calculation that made the entire precious metals community lose its mind. And I'll be honest with you, when I first saw that number, I thought it was insane. Then I sat down and actually decoded the math step by step, every assumption, every ratio, every historical precedent. And what I found is that the math is not insane at all. The assumptions behind it are where the real debate is. And by the end of this video, you're going to understand exactly where I agree with Tavi Costa, where I think he's being too aggressive, and what I believe the realistic target range for silver actually is. Because even my conservative version of his math gave me a number that changed how I think about this market. Let's start from the beginning, and I mean the real beginning. Because to understand why someone credible is putting out a number like $3,947 for silver, you need to understand the relationship between U.S. government debt and gold. This is the foundation of the entire calculation. During World War II, the United States had massive debt. Everyone knows that. But what most people don't know is that at the peak of that debt expansion, roughly 51% of all federal debt was backed by gold reserves. Half. The U.S. government had enough gold to cover half of everything it owed, and that gold standard, that discipline, that anchor is what gave the dollar its credibility during the most expensive war in human history. Now, fast forward to today, U.S. government debt is even larger relative to the economy. But the percentage of that debt backed by gold has collapsed from 51% to roughly 3%. 3. The U.S. still has 261.5 million ounces of gold sitting in its reserves. Same gold, but the debt has exploded around it. So, the ratio between what we owe and what we have in the vault has gone from 51 to 3. I want you to look at this chart because it tells the story better than I can. U.S. gold reserves as a percentage of federal debt peaked near 51% in the 1940s during the World War II era. At that time, the United States emerged from the war as the dominant industrial and financial power, holding the majority of the world's official gold reserves, while federal debt, though large for that era, remained modest relative to the nation's long-term productive capacity. Over the following decades, however, the situation gradually reversed. Debt expanded persistently through wars, entitlement growth, financial crises, and structural deficits, while the physical quantity of gold in official reserves remained essentially static. By 1980, the percentage of debt backed by gold rebounded to roughly 18%, not because America dramatically increased its gold holdings, but because gold itself repriced sharply upward during the inflationary turmoil of the 1970s. In essence, the metal adjusted to reflect monetary instability and currency dilution. This historical pattern shows that gold does not need increased physical accumulation to regain relevance. It simply requires repricing against expanding liabilities. If today's gold reserves were revalued to cover 51% of current federal debt, total reserve value would need to approach approximately $20 trillion, with around 261.5 million ounces officially reported in reserve. Dividing that target value by the ounce count implies a gold price near $75,000 per ounce. Emotionally, such a number appears extreme because it contrasts sharply with today's pricing framework. Mechanically, however, it is nothing more than the mathematical reconciliation of a relatively small fixed asset base against a vastly expanded debt structure. Modern sovereign liabilities have grown exponentially due to compounding deficits and interest obligations. When the denominator debt expands dramatically, while the numerator gold ounces remains fixed, only price can adjust to rebalance the ratio. This arithmetic underscores how small the physical gold base is compared to the scale of modern financial obligation. Applying a gold-silver ratio of 19 to $75,000, gold generates a silver price near $3,947 per ounce. The formula itself is straightforward. Divide gold's projected value by the chosen ratio. The debate does not revolve around arithmetic. It centers on whether such compression in the gold-silver ratio is plausible. Historically, ratio compression has occurred during periods of monetary stress, speculative momentum, and strong retail participation. In 1980, the ratio briefly approached 14 during a highly volatile environment. However, extreme compression phases have typically been short-lived and driven by intense capital flows. Therefore, While the calculation is mathematically consistent, its realism depends on both gold reaching elevated valuations and silver outperforming proportionally. The projection illustrates leverage rather than certainty. Even if the 51% backing assumption is reduced significantly, the conclusions remain notable. At 25% backing, gold would approach roughly $37,000 per ounce. At 18% backing, mirroring the 1,980 environment, gold calculates near $26,000. Even at just 10% backing, gold would still need to trade around $15,000 per ounce to align partially with debt levels. These lower thresholds require far less dramatic monetary restructuring. They simply assume that gold regains a modest role as a stabilizing reference point within a heavily indebted fiscal system. Importantly, none of these scenarios require a formal return to a gold standard. They reflect valuation adjustments within a fiat system under strain, where price becomes the balancing mechanism. The Dow-to-Gold ratio offers another historical lens for evaluating relative valuation cycles. Major peaks in this ratio occurred in 1929, 1966, and 1999 periods, characterized by elevated equity optimism and strong confidence in financial assets. In each case, extended stretches followed where gold significantly outperformed stocks. The ratio captures long-term capital rotation between paper assets and hard assets. When equity valuations become historically stretched relative to gold, the pendulum has eventually swung in the opposite direction. This does not imply immediate collapse, but rather gradual reallocation over multi-year cycles as macroeconomic realities evolve. Today, the Dow-Gold ratio sits near 10, comparable to levels seen in the early 1970s before gold's strongest advance. If the ratio were to compress toward 2.5, while the Dow remained near 49,500, gold would approach approximately $19,800 per ounce. This scenario assumes relative repricing rather than absolute equity collapse. Stocks could stagnate, move sideways, or rise modestly, while gold appreciates more rapidly. Ratio compression reflects comparative performance, not necessarily crisis. Historically, such adjustments have unfolded over years, often driven by inflation, debt expansion, or shifting monetary policy. Even more moderate compression to levels of 5 or 3.5 would still imply gold prices between roughly $10,000 and $14,000 per ounce. These projections represent partial mean reversion rather than extreme historical lows. Importantly, markets rarely require perfect repetition of past extremes to generate significant returns. Even halfway normalization of stretch ratios can produce substantial repricing. This highlights how asymmetric the current setup may be. Downside risk reflects normal volatility, while upside potential compounds if macro cycles unfold in gold's favor. During the 1970s, equities experienced prolonged stagnation in real terms, while inflation eroded purchasing power. Gold responded not merely to stock weakness, but to broader monetary instability. Rising consumer prices, oil shocks, geopolitical tensions, and expanding deficits contributed to declining confidence in fiat currency. Gold's repricing unfolded progressively, accelerating as inflation expectations became entrenched. The lesson is that gold does not require a market crash to perform strongly. It requires erosion in currency, confidence, or debt sustainability. The gold-silver ratio, currently near 60, has compressed during every major precious metals bull cycle, while the extreme low, near 14 inches 1,980, represented an unusual convergence of speculation and monetary stress. Ratios between 30 and 35 have appeared multiple times during silver outperformance phases. Silver tends to move later in the cycle, but with greater volatility. Because silver's market is smaller and more thinly traded than gold's, capital inflows can amplify price movements. Thus, even modest gold advances combined with moderate ratio compression can create disproportionately large silver gains. At $19,800 gold, a 35 ratio yields approximately $566 silver, while a 25 ratio implies roughly $792. If gold reached $15,000 with a 35 ratio, silver would still approach $428. These figures demonstrate silver's leveraged exposure to gold pricing dynamics. A change in gold valuation combined with incremental ratio shifts produces exponential percentage gains in silver. This leverage explains why silver often attracts speculative attention during late-stage precious metals bull markets. Supply-side considerations complicate the outlook. Higher prices typically incentivize exploration and development. Yet mining expansion is neither immediate nor guaranteed. New silver projects often require extensive feasibility studies, environmental approvals, financing, and infrastructure build-out, processes that can span 7 to 10 years. Additionally, much silver production is a byproduct of mining other metals, such as copper, lead, and zinc. This means silver output does not always respond directly to silver price signals, limiting rapid supply elasticity during demand surges. On the demand side, silver's industrial role continues expanding. Its high electrical conductivity makes it essential in solar panels, semiconductors, electric vehicles, and advanced electronic, medical, and antimicrobial applications further diversify demand. Structural supply deficits in recent years indicate that consumption has exceeded new mine output, gradually tightening above-ground inventories. While substitution and recycling can offset some pressure, sustained industrial growth increases silver's strategic importance within modern technology infrastructure. Risks remain meaningful. Fiscal reform, technological breakthroughs, reducing metal intensity, or prolonged deflationary recessions could suppress precious metals temporarily. Strong currency performance or tight monetary policy may also delay repricing. However, across multiple historical cycles, extreme debt expansions and elevated financial ratios have eventually normalized. Even conservative assumptions far below extreme projections suggest substantial multi-year upside potential if gold reclaims a larger relative role within global finance. Silver, due to its smaller market size and dual industrial monetary character, may amplify those broader macro adjustments. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make. Because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rarer. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical, stay informed.